All right, so for most of the day today, stocks really look like, and we look like we're going to get our second consecutive oversold cluster. I mean, we look pretty dire, like we had gone to new lows. We were going to keep kind of going bearish in the next week, and then right at the end, right in the last couple of hours or so, our last hour, things really took off to the upside and really changed the tone going into next week. Long lower shadow on the daily chart. It's got above the close of last week's long lower shadow. So again, not necessarily that we're like, oh, let's back up the truck and we're bullish again. But it appears to be like we've got some battle lines drawn here between the bulls and the bears. The bulls are showing up at these levels, at least in the short term. So we're going to talk about, now what's our expectations for next week, and if and when we do rally, how far up will we go to? Because lines are shifting with each new low point that we get. So we're going to take a look at where the current resistance levels are. Why is this rally going to be different than what we saw in March when things really took off and nearly changed the trend back to being bullish? So we're going to take a look at all that. What's driving the price action? Big move today in a risk-off asset class that might suggest that we have, on a longer-term basis, some more risk aversion to come, even if we might be bullish in the next little bit. So we're going to break all that down, take a look at what's driving things today, and then our trade idea is a stock that's been so bearish and has been grinding for a long time in a sideways pattern, and is set up for a pretty decent move. And we'll talk about how to trade that potential breakout pattern going forward in which direction. So let's go ahead and get started. Today is Friday, May the 20th, 2022. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's start off taking a look at the S&P 500 with the market forecast indicator, like we always do. There's our long upper shadow that we got at the end of the day. Very good close to the day on Friday. Avoided a second consecutive cluster. Kind of would have been a cluster of clusters. Again, like a second one here. We got less than 7% away from the 30-day moving average. That is currently falling. In fact, you notice the 30-day moving average is actually dropping because that will act as a resistance level. As you can see, it did it here a couple of times during that decline. Same thing on the rises, right? We might get a little bit above it, but not significantly. And that's when you get the 3 green arrows. It's actually a pretty decent sell signal, just like 3 red arrows are a pretty decent buy signal. But now you got that resistance level is dropping below, this confluence of Fibonacci levels that are all from multiple time frames. They're all lining up in the same area between 4125 up to about 4200. So there's going to be a lot of resistance. Now keep in mind that you think, oh, that's 75 points. How can you talk about a range of 75 points? Because the ATR is 100 points. 75 points is less than a full day's range. It's very easy to be able to trade 75 points. So that's why you want to give yourself some room on support and resistance levels, right? It's, within an ATR like that. But you have this 23% line of the long-term rally. You got the 38% level of this decline that we've had since the beginning of the year. This market sentiment decline, the orange line, since it went, from the bullish territory down to the bearish territory. And then now we have this current intermediate decline. So we've had 2 intermediate declines on this market sentiment decline. You've got its 38% retracement level at that 41.25. So multiple levels of resistance at the same price, which now includes the 30-day moving average. See, we didn't have that here. When we came up off of this low point, we didn't have so many. See, we were above the 23% retracement level. So we didn't have that acting as resistance like we do now. It took a while to break it. So, anything that takes a while to break is going to, that was a pretty decent support is going to be a pretty decent resistance after you break it. So, we didn't have that level above us. We didn't have 2 Fibonacci time frames above us. We only had the one, that one intermediate decline. We got up above it. We did not flip the script, right? We did not, get to the upper side, you can see this is where it was at. If I activate this and bring it up to that low point, you can see we did not get above the 78% retracement level there at the time. So we didn't flip that script. And then we noticed basically it was pretty much of a fake out pattern above that 62% retracement. But now it's, now we have 2. So we have, the 38% of this big run, the multiple intermediate drops, and then the 38% of and 50% of the current intermediate decline that we're on. And of course, your 30-day, your where we're at relative to the 30-day moving average. See, the Nasdaq's got the same thing. You've got, let's see, we have to activate it and get it down to its current low point, Friday's low here, and we'll get this one down to Friday's low as well. And you can see again, you have 38% retracement of this current drop sitting right on top of the 38% retracement of the long-term rally. See, this one's further below. We've actually dipped below the 50% retracement of the long-term rally, which is different than what we saw with the S&P, right? The S&P is barely below the 23%. It took a while for the S&P to break the 23%, not the Nasdaq. It broke it a long time ago. Remember, the S&P was right here. You're at the 23% retracement. So we also avoided another cluster there. We are 9.5% below the moving average. But as we rally up to it, you're going to have resistance at the 23% retracement of this drop and these multiple levels, and probably will be the 30-day moving average too by the time we get there. Again, we didn't have all of that here. We just had that 23% retracement. Now we have the 30, which is actually a stronger support and or resistance level than the 23% retracement level. The 23% line is. You look at the Russell 2000, again, very similar. You have this 38% of the long-term rally off the COVID low, the 23% retracement of this market sentiment decline, again, very similar to the Nasdaq, and then the 38% of this current intermediate decline, all sitting right about this 1885 plus or minus a few points. Remember, the ATR is 54 points, so you got to give it some range. But that's, any rally we get is going to be limited in that area, right? And there's other, resistance you'll see here on the chart that's in that area too. Volume, resistance are also in that spot. Let's go to the weekly chart for the S&P 500 on the market forecast. Again, a second, we got this long, let's see, let's go to the weekly chart. There we go. And here's it. There's that long lower shadow from last week. We traded inside the lower shadow. So very similar to what we did over here that preceded the rally, right? We had the long lower shadow. You traded, this case, 2 weeks inside, but you didn't close. We didn't go below it either, but we didn't close. That's the most important thing. We didn't close there. And you notice same thing. We did go below it a little bit, but we didn't close there. And you're nearly bearish. It doesn't stay down this long. And your intermediate line now, it's the near-term line on this chart that when it gets below 10, it's a pretty bullish signal. Here, your intermediate line's almost below 10. It's actually below the 12th percentile, and we are 12.5% below the 30-week moving average, which, for context here, we don't typically get this far below the 30-week. There's the fourth quarter 2018, 15, 16. Right, if I were to flip, move this line, it's actually minus 12.58 now. So this is where we're at now. This is about as far down we got in 2018, 15, 16. But it's about as far down as we got in 2011. And then even at the correction that started the bear market in 2007. Remember, bear markets start with a pullback that fails. Corrections start with a pullback that fails. Bear markets start with a correction that fails. And then you have your bear market. And then bear markets just go nuts at the very end. They kind of build up their strength at the very end. So the correction move got this far down. So you can see this is a pretty decent level, 12.5% below the 30-week moving average. You notice over here, we never did get significantly back above it. We only got, a little bit, less than 2% above it when we got the failed correction bounce. So here we are, that far below it, and we'll see if we ultimately get, start to move back up towards it. Same thing with the NASDAQ 100. Again, you can see how far below we are, nearly 20% below, which is lower than any of these others, right? It was lower than the COVID, lower than 2018, way lower than 15, 16, way lower than 2011, and for that matter, also lower than the correction that started that bear market, and lower than the 06 correction. I mean, that's a pretty decent drop, way more. And you can see We had a weekly cluster 2 weeks ago, which is not very common, and its intermediate line is below. You can, to kind of give you an idea, there's a fourth quarter 2018, the weekly intermediate line never got below the 10th percentile. Over here in the bear market, so there's the correction that started the bear market. It got to the 10th percentile. It never did get below the 10th. This one got to the 8th percentile at its lowest point. And when things really hit the fan in 2008, we're below the 7th percentile right now on the intermediate line. So it just goes to show just how extreme the selling has been. I mean, shoot, 7 weeks in a row on the NASDAQ. And then finally, your Russell 2000 is not as bad, but it's also below the 7th percentile, coming off of a cluster, 15% below the 30-day moving average. COVID was worse for the 30-week moving average, COVID was worse. It's about the same as 2018, about the same as 16, about the same as 2011 as well, about the same as that initial correction that started the bear market in 2007. So needless to say, I think that there's some pretty decent indications here. You can see we did get below, we got to the 8th percentile. So this is still lower. The intermediate line that's below 7 is lower than 2018, lower than COVID, lower than 15, 16, lower than 2011, and lower than the correction, right? So lower than, in fact, really, it got this here. We got to the 8.5 percentile at the worst at the lowest point of the bear market. We got to that 8th percentile. We are below the 7th percentile. So needless to say, again, we are a lot more bearish right now. Remember, the Russell 2000 has corrected, so it did get down to that 200-week moving average, whereas the NASDAQ and the S&P are still working on that. Needless to say, we had a class on this in our technical analysis class on Friday at Market Scholars, where I shared other signs that I believe that this correction will eventually turn into a bear market. It needs to bounce first. You need to have a bear market because there's lots of corrections. So you can't say every correction will be a bear market. And you never know, right? You just really never know until it bounces and fails. So we have to bounce. We have to stop the correction, finish it, usually at the 200-week or around the 200-week moving average. We have to bounce and fail back at these long-term moving averages, like the 30-week and the 50-week, and then bounce back down and break the 200 again, and break the 200 for good. That's when the bear market starts, when we've bounced back down and broken the 200-week again. So we never know, but there's a lot of indications, and I shared a lot of that in Friday too, that this correction will, after we finish, and after we bounce, and after it fails, and after it breaks back down, that this will eventually turn into a bear market. I think we're ahead of it. That takes weeks. It takes multiple months. It takes, a good 5-6 months or so, just kind of throw a number out there. So it takes, in other words, it takes time. It's not going to happen next week. We're not going to go into bear market mode next week. It takes weeks and weeks to finish this. I mean, it's taken all these weeks since the beginning of the year just to correct. So it's going to take weeks to bounce and fail. And I don't think that's happening. I think we're just getting a short-term bounce here for about a week or two before we finish the correction. For the Russell 2000, I think it's back down to here, this 1545 level at least by the time it's all said and done from a correction standpoint. Let's take a look at this chart, this other weekly chart, and you can see that, let's see here, bear with me 1 second. Okay, you can see that we did not close below last week's low point. We did get a lower close. If you look at the same chart on the NASDAQ, again, they're bearish candles, and you got a red line, you got a falling PPO, which is down 7%. In fact, if you look at the NASDAQ's PPO there, that's one of its worst PPOs. That's worse than any of the other corrections. It's worse than the COVID. It's worse than Q4 2018. And remember, this is measuring the gap between the 10 and the 40-week moving averages up here. It's worse than 2011. It's worse than all of these. It's worse. It's about as bad or worse, actually, than the first correction that turned into the bear market, right? And then worse than that correction. And it's still dropping. You can see the candles are still pretty bearish. But you're not getting. We got to close below that last week's low. We did not get a close below this week's, past week's low this time. And we'll see if we end up getting a higher close. They're all lower closes still. If you look at the Russell 2000, again, very similar, but remember the Russell just really got hammered hard on COVID, as well as 15 and 16. So this is about as bad, though. I mean, of all these others, it's about as bad as it gets for the Russell. And the Russell barely got a lower close. Barely. And it did not get a lower low point from a weekly basis. So again, not as bearish as it could be. Sounds like a campaign slogan, doesn't it? Not as bad as it could be. If you take a look at the 3 green arrow charts, you see that we have 2 charts that are not shaded pink. So the Qs and IWM, we have green arrows in the MACD on both of them. The rest are still 3 red arrows. So again, we're not bullish until you get 3 green arrows that stick, right? That don't just stay for a day or two. So, and we're not going to get that 3rd green arrow, as you can see, until you get above that 30-day moving average. When you look at the 2-line version of this chart, so again, long lower shadow, really, really good bullish opportunity. But we're still not even above the 8-day moving average. And again, you can see that same resistance level is also the bottom of the value area for the S&P 500. It's another layer of resistance at that same 420, 4200 level. There's a lot of volume that's going to be above that. And the gap, see, the gaps weren't so wide between the 17 to 30, the 30 and the 50. And we were able to get through it in pretty much 3 days. Now your 17 and your 30, there's a bigger gap than we ever saw there. There's a bigger gap between the 30 and the 50 than what we saw, at least by the time we crossed. So, there's a pretty decent sized gaps. It's hard to break through all of them unless they have started to converge at some point. And that's just not the case right now. You take a look at the Qs and the same thing. That resistance level, there's some volume here. There's some more up here at the value area, as well as that 38% retracement. I mean, that's kind of best case scenario for it to get all the way up to its 50-day moving average for the Qs. Of course, best case scenario is obviously we just turn back around. But if we stay bearish, that would be the best case scenario, and still maintaining that. Look how far below the value area the Russell is. That's so bearish to be that far below. And you can see the volume starts to pick up here at the 38% retracement of the market sentiment decline, which happens to be also 2. So I think your best case scenario is to get back up towards 200 on this chart, but still staying well below the 200 week. Again, very similar to that. You got above the 50. You couldn't quite get all the way to the 200 there. Take a look at some of these other oscillators. You can see, we're still above 30. We're still below 20. So that hasn't changed on SPY. The other charts look very similar. RSI and CCI are still at bearish levels, still below 0, still below 40, so still very bearish levels from that perspective. The Ichimoku cloud, still very mature, bearish trend, that hasn't changed. Big gap between, when you get these big gaps, it's hard to break them both, right? So you got big gaps here well below the cloud, so that hasn't changed. That's a pretty steep pink cloud that we haven't seen that before. You can see when we were bearish over here, the cloud was kind of sideways for a while. It was kind of stair step. This one's a pretty decent free fall. You can see if I were to go back to COVID, there's your COVID. That's the pretty free fall, but the gap wasn't so thick as it is right now. So you can see it's pretty thick here. And then there's 2018. It was kind of a stair step. We went down, sideways, and down. Here we went down, sideways, down, and we're going down again on this. From a Bollinger Band perspective, if I take a look at the Keltner channels with the Bollinger Bands, you can see we're not in between, right? So the bands are still outside, so we still got a green dot. So we haven't turned red yet, but you can see the momentum is waning. The bearish momentum is turning up. So we're not as bearish, and we're probably, in my opinion, going to start consolidating. You have a really high Bollinger Bandwidth that you would expect will consolidate in this area and start to build out some more volume, to have more volume below the value area than we have above it up here. So I think that's going to be the expect. Between now and June expiration, I think we're going to come up and then just kind of fill in this area, up and down moves, but without really trending up or down. And we'll let that bandwidth come down to a lower level before we break out of it again for a new leg. In this case, I would expect that leg would be to the downside. Let's take a look at the intraday move. A higher high, a lower low, and we went below last week's low, but we finished above yesterday's low and last week's low. So really good, strong finish that saved it. I mean, we would have been below last week, so that would have been pretty bearish. But a good rally at the very end of the day saved what could have been a really bearish candle. So we'll see how much of a follow through. You can see we're still below the 4-week value area, so it's still pretty bearish and well below the point of control. And again, 420, or yeah, 420 is where that resistance is, way up here. So we'd have to flip this all the way around and get up to a high point. Now, when you look at the Arun indicator here, you can see, this has got to get below 70 before we really start to, feel good about a low point having developed. And we just barely got a new 4-week low today. So we're not going to be below 70 for a while. It's going to take a few days to develop. And you can see you can do that. You can form a low point at a new low point, and then it takes a few days by the time you get, below 70. And then you'll see if we get one of these spikes to a new 4-week high point. We didn't get one there. I don't think we'd actually get one here either on this next little rally. But at least you would get a change in the hull, where the hull stops being so bearish on the daily Hakanyashi, and we turn back up and we start. We were well below the 200-day hull, more so than we were over here. We are set up for a pretty decent move. Like, again, we've had a red daily hull for so long, well beyond the 20-day mark, that you would expect that we'll start to turn up, flip the parabolic SARs, and have more of this kind of move with a green hull. This is, again, the kind of move I expect that we're going to get. And then essentially this expiration cycle right here between January and February is the expiration cycle I expect we'll have going, into June expiration. Let's take one last look at the volatility chart. You can see, it's high, 29, but it's so low, which means VIX 3M is still very high, which means the market's still anticipating a pretty decent move, like an extended move, like one that will last longer than your typical, spike to the downside like we saw when we put parabolic. We're just not, again, you don't really hit the low point until this gets up. In this case, especially with this kind of decline we've had. Look, we've been above 20 for a long time. If you go back, to kind of give you an idea, like, we don't stay above 20 on the VIX unless we are in correction mode. Like fourth quarter 2018, we didn't stay above it for that long. 15, 16, we didn't stay above it for that long. But you notice we've been above it now for multiple weeks. Pretty much all year we've been above 20. Like, we weren't above it for very long there. We weren't above it for very long here. We went up and down, up and down. 2011 is a little different story. We spiked up to 40, so we stayed above it for the rest of that year and then got back down. This is a pretty decent extended run. So you'd think, man, we should be really bearish. And to be above 20, last time we were above 20 this long was COVID. And it took a move all the way up to 75 to stay above 20 for that long. So we're not really extending to extreme levels. It just means, it just shows how kind of pernicious this move is. It's just like kind of like a death by 1,000 cuts type of a move that's not over with. That's not, we haven't gone, since we didn't get the parabolic move to start the decline like we did in 15, 16, we're going to get the parabolic move more likely to end it like we did in fourth quarter 2018. Of course, nowhere near that right now. So what do you think? So, do you agree with that? Like, the expectation that probably next week and into June expiration, the early part of this expiration cycle will rally. The late part of the cycle will probably pull back and just kind of be noisy for this expiration cycle. Do you agree with that assessment? Do you disagree? Let me know in the comments below, especially if you disagree. What charts or indicators you're looking at that suggest why you're either a lot more bullish than I am or a lot more bearish than I am. All right, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over this icon here in the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below the video if you're watching us on YouTube. That notifies you when our videos are posted. Also, while you're down there, hit that thumbs up icon. That tells us two things. One, you liked the video today, and two, you want us to do another video again tomorrow. It's a quick way to give us feedback if you like your stuff. Of course, if you don't like it, you don't have to click on anything. You don't even have to watch if you don't want to. Also, while you're down there, comment. What stood out to you? What questions or comments do you have about today's video? Post those in the comment section. Join our website at marketscholars.com. There's a link popping out up there in the top right corner of your screen. Click on that link to subscribe to our site for free. Follow me on Twitter for more content between the videos from day to day. There's my handle at DavidSettle42, and join our Market Outlook Facebook group that we've created. All Right, if you're watching us here on our blog, you can check out some of these other things over here on the right. Click on this icon. It takes you to our Market Outlook live page. Monday, Wednesday, and Fridays at 3:30 Eastern Time, I do a live 10-15 minute video here on this page. I take a look at all the trades we've done in prior Market Outlook videos. And I also put on that day's trade idea during the video before the market closes. So usually about half an hour before it closes, so you can kind of get an idea early instead of waiting for the next morning before the market opens up again. You can also get to it by clicking on Live Trade Review in our main menu. Come down here, click on. You can see our upcoming classes. Click on View More. Takes you to our calendar with all of our classes for the upcoming week, rest of the month, and then all the recorded classes going back 4 years. Come down to the bottom, click on that heart. Look, we got over 100 likes. That was awesome. Thank you very, very much. And keep doing it. Again, it helps tremendously the more likes there is. So click on that icon. It takes you to this page. Again, you can do that like right now while you're watching. Same thing with this thumbs up icon. It does the same thing for us on Facebook. Click that like button. And the more you do it, the more people see our content. That's why we always ask. It also benefits you because the more you do it, the more they'll show you our stuff. They make sure that you always see our stuff because you engage with us. So you can engage with us right now while you're watching here. We try to make it really easy for you. All right, now let's take a look at what's driving the price action, especially by the end of the day this week, by the end of the week really. Still, over the last 3 months, commodities and the dollar are your stronger asset classes. Everything else is on the downside, with bonds, emerging markets, and the Qs. That's just not the three things you typically lump together. But let's take a look at just how this week performed. So let's get out to May here, going all the way through the end of the week. And you can see the Qs were down almost 7% for the week before just really taking off, and are only down 4.5%. And same thing with SPY, it was down 5 at one point, finished with only a 3%. Small cap stocks really outpaced. And again, they were down 3% at one point, but they only finished down 1%. So nice rally. Now, granted, at the end of Thursday, they were actually higher. At the very beginning of Friday, they were up on the week with the Qs down 3%. So small caps have really been a better performer. Emerging markets. Remember, emerging markets are down 3 months. Not this week. Emerging markets are actually positive, and they were pretty much positive most of the week. Brief little downturns, but for most of the week they were up here. But you notice it's one of the first weeks that bonds ended up being relatively strong. Let's take a look at its weekly chart here, and you can see long-term bonds really took off. They're like 2 weeks in a row. A little bit of a piercing line last week, and then following that up. Haven't closed above the 8-week moving average yet. It appears that the MACD may be bottoming out. I remember it doesn't converge for as long as your bullish convergences are, but we're also way far away from the 17-day moving average. Like you can see, you actually converged here for a while until you finally broke. The MACD turned up. It turned above its moving average. So you really had about 6 weeks before it finally got above the 17-week moving average, and then made a run up. At that point, you were bullish. So it appears that we'd be kind of in this stage right now. In this case, well below the 200-week moving average at the bottom of the 5-year. In fact, we're pretty much at that low point from the fourth quarter of 2018, right before, when in the midst of that correction for the next pretty much 2 months, November and December, long-term bonds rallied and then continued to rally throughout 2019 into the COVID and then post-COVID peak that we had there. So pretty decent run on bonds. Really bearish week on the dollar. In fact, it's one of the biggest bearish weeks that we've had. The MACD appears to have peaked there with the histogram. Stochastics rolling over. Big time volume the last 3 weeks as we're trying to figure out this peak. So that's a big move. Really, really significant move on the U.S. dollar. Again, not breaking the 8-day yet, not breaking this 23% retracement, and we're still above the value area for the 5 years. So we're not out of the woods. It's not completely bearish, but it kind of gives you an idea. Remember, so this is a down week on the dollar. We've seen how stocks and everything have performed this week. For the most part, was down. So kind of an interesting period. Here's the daily chart, And you notice we are now back below the 17-day moving average for the first time in more than an expiration cycle and a half, that we've been above the 17-day. Now we're breaking below it, and you can see if we do break this volume node, there's not a lot of support until you get down into some of these areas. So we have an opportunity for the dollar to be pretty bearish. And I'm not sure that's necessarily bullish risk appetite. It seems like the dollar has been rallying for most of this bullish move in risk appetite, and it's just now starting to move over. Of course, one of the main reasons the dollar is dropping is because the U.S. yen is dropping, and the U.S. yen is very much a safe haven trade, right? So when risk is off, then this currency goes down, and it's been so bullish during most of this year's quote unquote correction. But we broke the 17-day. You made a little bit of a rally up to the 8, it failed, and then you broke the 17-day again, and now I've broken the 30-day with a gap to fill down the 125, and then potentially all the way down. You can see from a weekly chart just how parabolic that moves. So this is one of the biggest reasons, and this is not a risk on trade. When the dollar's bearish, it's pretty risk on, but when this is bearish, it's not risk on. It's actually more of a risk off trade when this is bearish. So it kind of gives you an idea of just how parabolic we've been, and how much pressure the risk trade might be under from a reflected in how bearish this is, among other things, right? And of course, Bitcoin and ARK investments. Bitcoin had a pretty mild week when you look at the Hakinyashi candles. We did not get a lower low, but we did get a lower close, and now it's just a matter of how much. We're probably going to start off at 32,500. We're already at 29,000. So you're going to get a bearish candle next week. It's just a matter of how bearish and whether we keep breaking the 29,000, which is a really important level. If we break this 29,000 area, because that means we're breaking support at 29,000 there, 95. You're breaking support, and you're working your way into an empty area of volume, potentially to and potentially through its 200-week moving average down to this 18,078% or even more. I think as we continue to correct risk appetite, this will probably more likely make it all the way down to those levels. All right, let's take a look at the sector rotation. And so we'll look at the comparison chart first. Again, just go to this week. That was so bearish until the very end of the week. And you can see the consumer stocks really didn't rally very much at the end either. They got hammered, whether it was staples or discretionary. It's a bad week across the board. Technology, Apple's still putting a lot of pressure on the XOK. And you can see the only things that were up were energy and materials. The weakness in the dollar finally helping propel those higher, and then utilities and healthcare. So safe havens across the board outperforming. When you look at the 12 grid here, and you see the cyclical areas at the top, but you can also see staples down here, and then real estate. We're pretty bearish. Really, the only things that are kind of escaping the bearishness are energy stocks, material stocks, and utilities. Utilities kind of being held up by the safety trade, healthcare as well, by the safety trade. Materials and energy being held up by a pretty meaningful reversal in the dollar and in long-term bonds. All right, our trade idea for today is Toll Brothers. Toll Brothers has been really kind of converging and just going sideways for a very long time, kind of setting up a move. Here you can see the intermediate line has gradually come off from all these clusters, moving up to the upside. If you look at the weekly version, we've had a lot of clusters over here the last few weeks. And in fact, if we were to activate this and move this all the way up, get this back down to these COVID lows and get this up to that cluster. You can see we're kind of sitting on that 50% retracement and kind of stalled, and there's a reason why we've stalled there. If you look at the with 3 green arrow chart, you can see we're just a little bit underneath the value area for the 1-year basis. When you look at the 5-year chart, we're sitting right at the 200-week moving average. So Toll Brothers has corrected. So now you look for it to bounce back up towards these moving averages, right? The 30 and 50 day or week moving average. You can see you also hit some very strong volume support as well, including the top of the value area over the last 5 years. So very significant support in this area. All these oscillators are at very neutral levels. You can see both the positive and the negative are below 20. So very, relatively neutral from that perspective. The RSI and the CCI are right in the middle of their charts, about as neutral as you could possibly be. And then the Ichimoku cloud, we are just sitting right below the cloud, and no trend going at all. We had such a bearish trend, and now we've converged. We've really converged to the point where pretty much all the moving averages are sitting right on top of each other right now. All of them, the 50, the 30, the 8, the 17, obviously well below the 200, but all these lines have all converged. You're setting up for a move in one direction, one way or the other. The Bollinger Bands have really kind of tightened up. In fact, when you look at them in relation to the Keltners, they're way inside the Keltner. So red boxes, no momentum, just waiting for a breakout. And considering again your 200-week moving average that we're sitting on it, you would expect potentially that breakout to the upside. When you look at the other weekly charts here, you can see we had bearish trends. We have stopped. We don't have a green arrow yet, but we've got a lot of, 1, 2, 3, 4, 5 weeks of transition candles with the PPO now starting to rise up slightly in a positive differential. So all you're missing is a green line. You're pretty darn close when you look at the regular candles. That's how close you are to getting a green line. So we're pretty darn close to getting one. So there's an opportunity here for a bullish trade. Be a little bit aggressive on the bullish trade opportunities. So when you look at its options chain, you say, okay, how about we buy, let's see, sell the 55. Was that what we did? Let's see here. I believe it was, no, it was in June. So we sold the 55 and bought the 50. And again, it's going to kind of depend upon where we get filled in at here. Probably have to get, we're a penny or nickel increments, so you probably have to go to $1.30. But if you analyze that trade, you set slices to break even, and you probably do a few contracts here. You're getting about a 3-to-1 reward to risk ratio with my break even. Oops. Right above that level. So we'd have to basically get above the 38% retracement level to be making money. And then again, it's a $55 strike, so we'd have to be up towards the first standard deviation move by June expiration. So again, kind of a low probability directional opportunity, but a pretty decent reward and a very low risk. Pretty decent reward if it works out, very low risk if it doesn't. All right, well, that does it for today. You've heard from me now, and I want to hear from you. Use that link that's popping out in the top right corner of your screen that takes you to our Market Outlook forums. Open up any new thread with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. As always, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video down below. Have a great rest of your weekend, everybody, and we'll see you all next time.